A modern professional works 40 to 50 hours a week, chasing promotions and annual raises. But for millions, that physical and mental exertion results in entirely stationary economic progress. Society conditions the middle class to believe a simple equation: a higher salary equals greater wealth. Medical professionals, lawyers, and corporate managers often fall into the trap of believing that pushing their income bracket higher is the primary mechanism for financial independence. The actual economy operates on a different. The true divide is not measured by income brackets, but by behavior. It splits the population into two distinct categories: the consumer and the owner. Author Robert Kiyosaki highlighted the core difference between these two paths. An asset is simply something that puts money in your pocket, regardless of whether you are working. A liability is something that takes money out of your pocket. Relying entirely on wages means playing a game with a hard ceiling. There are only so many hours in a day you can sell. The accumulation of assets operates without those limits. In 1899, economist Thorstein Veblen identified a phenomenon that contradicts standard supply and demand. For certain luxury items, an abnormally high price actually makes the product more desirable. This became known as the snob effect. Veblen observed what he called conspicuous consumption. This is the practice of purchasing expensive goods specifically to display economic power and secure social status among peers. Today, sports cars, designer handbags, and luxury watches fulfill this role. While they are often rationalized as investments, they are depreciating liabilities requiring constant maintenance, insurance, and taxes. This chart shows global luxury spending demographics. A massive 70 to 75% slice of this market is driven not by billionaires, but by middle-income households earning between $40,000 and $150,000 a year. The ultra-rich are not the primary forces keeping luxury conglomerates afloat. Instead, working professionals make an active choice to prioritize the appearance of wealth over the acquisition of actual equity. By converting hard-earned wages into depreciating liabilities to signal status, the middle class actively liquidates the exact capital they need to build lasting financial security. The divide between the consumer and the owner is aggressively widened by a neutral mathematical law: compound interest. It acts as a multiplier, accelerating a person's trajectory in whichever direction they are already heading. This line graph illustrates how compounding punishes the consumer. An initial credit card balance, subject to daily compounding interest, curves exponentially upward over a 20-year period. Every single day a balance remains, interest charges are added to the principal to create the next day's calculation. When the payoff timeline is extended to 25 years through minimum payments, this second trajectory emerges. The compounding effect inflates the total amount owed until the borrower pays more than double the initial balance. For the owner, this mathematical property works in reverse. Dividends, capital gains, and interest payments are reinvested over decades, generating returns on the returns. The consumer experiences a relentless daily drain on their checking account, while the owner's portfolio experiences patient annual growth that accelerates as the base principal expands. Over an average working life, this compounding ensures the wealth gap widens automatically. The mathematical momentum eventually overpowers any standard wage increases the consumer might earn. Zooming out to the macroeconomic level, this divide is reinforced by the dual nature of inflation. Consumer inflation is the rising cost of everyday goods, like groceries and energy. Because salaries rarely adjust at the same pace, this functions as a direct, unlegislated tax on the wage earner. Asset inflation operates differently. The values of stocks, bonds, and real estate surge, which directly multiplies the net worth of those who already own them. Central banks trigger these forces. Accommodative monetary policies, low interest rates, and systemic capital injections into the financial system provide cheap financing for asset acquisition. Look at this K-shaped divergence chart based on Federal Reserve data from 2019 to 2022. The top arm points sharply up, representing a 30-70 net housing values rose to $201,000, and stock market participation increased substantially. The wealth surge belonged almost entirely to those holding these specific assets. When fiat currency loses its purchasing power, that value does not disappear. It transfers directly to the owners of hard assets, leaving the uninvested to absorb the rising costs of living. This K-shaped recovery raises a critical question. We must ask if this is the natural outcome of a free market or the result of a specific structural design. Economists point to several structural drivers of modern inequality. Advanced economies have shifted away from manufacturing toward service sectors, while technological change and rapid globalization have rewritten the rules of employment. Within this environment, market power dynamics and political policies consistently favor the protection of capital. Corporate earnings and asset gains are frequently shielded, while the taxation of labor wages remains stringent. Waiting for sweeping legislative reform or systemic economic changes is an agonizingly slow process. Macroeconomic structures move at a geological pace, far too slowly to rescue an individual during their working years. Recognizing the system's bias toward capital is necessary for understanding the economy, but relying on the system to eventually correct its own inequalities guarantees decades of financial stagnation. The solution for the individual requires an aggressive transition of financial habits. The wage earner must consciously adopt the behavior of the owner to cross the economic divide. The immediate first step is to halt the acquisition of status-signaling liabilities. Every dollar spent on luxury goods to project an image of wealth is a dollar drained from discretionary income. The second step is to systematically eliminate daily compounding consumer debt. Stopping the negative exponential math of credit cards and high-interest loans is a prerequisite for keeping any generated wealth. Finally, earned capital must be aggressively redirected into income-generating assets. This means buying into accessible markets, whether through index funds, real estate, or business equity. The required shift in perspective is realizing that human labor does not scale. You cannot physically trade enough hours to become wealthy. Your money must work independently of your time. True generational wealth is never found in the salary you earn. It is exclusively built by the assets you own.